My name is Terry Cuff, and I would like to welcome everyone here today on behalf of the taxation section of the Los Angeles County Bar Association. What we have tried to do is to react to the tremendous disasters that we've had in the Los Angeles area through fires. The LA County Bar is trying to do what it can to help people. This is one of various programs that the LA County Bar is putting on. And in addition to this, and in the chat feature that you should have on Zoom, we have put a link to other materials that the bar has put on its website that we hope are going to be helpful. Well, fortunately, we've been able to gather together an absolutely outstanding cast of speakers from across the country. These are some of the best, most qualified people in the country in the area of federal income taxation. Each one will be talking about different tax aspects of the fires. Our moderator today is Levon Lawson, and I will try to say no more. Levon, take it away.
Thank you, Terry. And hello, everyone. Yes, I'm Levon Lawson, and I am an attorney with the business law firm Leach Tishman. They're corporate trust and estates and taxation groups, and I am the program moderator for today. There's a lot of information in this program. We have a number of topics and speakers, but questions are welcome. You can place questions in the Q&A. The Bar Association has provided program materials via email and the chat box, where you will also find additional materials, as Terry has indicated. Some speakers may place their materials on screen and others may not, but you will have the materials, which will include speaker information. Our panelists are the following. Michelle Cable is an attorney with the firm Falcon, Rappaport, and Berkman. She practices in their taxation, private client, and digital assets groups. Matthew Rappaport is a named partner with the firm Falcon, Rappaport, and Berkman, where he is known for his work on complex deals involving tax considerations, such as Section 1031 exchanges. Adam Handler was formerly with the accounting firm PricewaterhouseCoopers and was well known for his understanding of involuntary conversion. Rob Wood of Wood LLP is known for his understanding of taxation of settlements, on which he is a prolific writer and speaker. Cesar Reynoso is an attorney with the firm Agilat Pali Ayud Madarisi and Broge, known for its focus on state and local taxation. And Megan Jones is a partner with the law firm Pillsbury Winthrop Shaw Pittman, where she focuses her tax practice on advising entities, family offices, and individuals on planning matters. And I'm going to move us over to Michelle Cable, to discuss Rev Proc 2018-58 and its impact on due dates. There we go. You are muted.
Sorry about that. Good evening, everyone. My name is Michelle Cable. The information on the screen is a bit duplicative of what Topher just covered, but just to reiterate, the IRS did issue a disaster relief notice on January 10th in response to the California wildfires. It identified the disaster date as January 7th and identified affected taxpayers as individuals and businesses in LA County. LA County is the covered disaster area. Certain non-affected taxpayers who maintain their records in LA County may qualify for relief under the notice. Most tax filing and tax payment dates that fall on or after January 7th, but before October 15th, are postponed to October 15th. Hold on, I'm sorry. I'm seeing my face and not my screen, and that's uncomfortable. Okay. Okay, apologies for that. So, and the notice also makes reference to Revenue Procedure 2018-58, which is particularly important for taxpayers involved in a 1031 or 1033 exchange. It's important to note that the revenue procedure itself does not provide the relief, but it extends the relief granted by the IRS to the taxpayers. For taxpayers involved in a 1033 exchange, any required deadline or election that was required to be made during the relief period of January 7th to October 15th are extended to the general postponement date of October 15th. Taxpayers involved in a 1031 exchange, however, may choose the relief, if they're eligible for relief, may choose relief under Section 6 or Section 17, but there are some requirements that each section has. And so we recommend that taxpayers consult with their tax advisor to determine whether they qualify for relief. But I do go over the two sections, who qualifies for relief under each section and how they impact the exchange deadlines. So Section 6 applies to only affected taxpayers, and it extends any 1031 exchange period that falls on or after January 7th, but before October 15th to October 15th. Section 17, on the other hand, requires that the exchange occur or begin on or before the disaster date of January 7th, and that the taxpayer either be an affected taxpayer or have difficulty meeting an exchange deadline. More on this in a few slides. Section 17 extends the deadlines, the 45-day or 180-day deadline under Section 1031 by 120 days or to the general postponement date of October 15th, but the postponement cannot go beyond the due date of the taxpayer's return for that year, for the year of transfer, including any extensions or 1 year. And then I do have examples that demonstrate the differences between in relief between Section 6 and Section 17 in the next couple of slides. So in example 1, we have Sam, who is an LA County resident, and he began his exchange period on January 1st. That would make his identification period fall on February 15th. He must complete his exchange by June 30th. As we know, the disaster date was on January 7th, and the general postponement date is October 15th. So with this information, we know that Sam is an affected taxpayer, and he began his exchange before the disaster began. This means that he's eligible for either for relief under Section 6 or Section 17. He cannot choose both. He has to choose one. Under Section 6, both of his exchange period deadlines fall within the relief period, and so both of those dates are extended to October 15th. Under Section 17, the deadlines are extended again, either by 120 days or to the general postponement date. Now, if you consider his 45-day deadline, which falls on February 15th, if you extend that by 120 days, that gets you to May 1st. But if you extend it to the general postponement date, that extends it to October 15th. So obviously that is later. And so Sam would have to identify property by the general postponement date. But if you look at his 180-day exchange deadline, that originally falls on June 30th. If you extend that by 120 days, that gets you to October 28th, which is later than the general postponement date. So in other words, under Section 17, Sam may extend his identification period to the general postponement date, but his 180-day deadline by 120 days. Example 2, similar facts, but instead of relinquishing his property before the disaster begins, he sells his relinquished property in June, making his 45-day deadline at the end of July, and he must complete his exchange by December 12th. Again, Sam is an affected taxpayer, but he sold his relinquished property after the disaster began. This makes Sam ineligible for Section 17 relief, but he is eligible for Section 6 relief, only partially. So his 45-day exchange deadline falls within the relief period. So that is extended to the general postponement date of October 15th. But because his 180-day exchange deadline falls outside of the relief period, his 180-day deadline is not extended. So he gets partial relief under Section 6. In my last example, we have a different taxpayer by the name of Megan. She is a resident in New York, and she sold relinquished property in New York before the disaster in California began. She timely identified replacement property in LA County. Her exchange deadline is February 15th to identify and June 30th to complete her exchange. Due to the disasters in California, she's having difficulty closing the replacement property before June. This is kind of assuming we're closer to June than we are. And the question is whether she qualifies for relief under Section 6 or Section 17. Well, she's not an affected taxpayer, so she's not eligible for Section 6, and it only leaves Section 17. She is not an affected taxpayer, but her exchange began before the disaster began, and she's having difficulty meeting an exchange deadline, so that makes her eligible for Section 17 relief. The revenue procedure does explain or provide a list of what qualifies as having difficulty or reasons that a taxpayer might have difficulty meeting an exchange deadline. This includes either the relinquished property or replacement property being located in a covered disaster area, or God forbid, somebody involved in the transaction is killed, injured, or missing, or a document gets missing. All these reasons may demonstrate difficulty. And so if a non-affected taxpayer believes that they are having difficulty meeting an exchange deadline and believes that they may qualify under Section 17 relief, they can look at this list to confirm. But we do recommend that they reach out to a tax advisor to confirm, because 1031 deadlines and 1033 deadlines or 1031 deadlines are non-curable. And so we would hate for them to think that they have relief under Section 17 or Section 6, and they actually do not, and their exchange fails. So that covers my portion of the presentation. If there's any questions, please let me know. You can message me or we can discuss at the end. But I am going to turn the floor over to my colleagues, Matthew Rappaport and Adam Handler.
Thanks, Michelle. Adam, it's your rodeo on 1033, so kick us off.
Okay, thank you. Yeah, I'm coming to you live from a fire-damaged home in Pacific Palisades. I'm drinking free water provided by the LA Department of Water and Power. But at any rate, it's rare that you have a program that affects you directly like this. So 1033, it's a section that people never think about until it becomes absolutely crucial. So it's a very old provision of the code, and the best advice I can give people for you before giving advice on it is read it carefully, read the regulations, look at the case law, because a lot of the provisions don't make sense, or they don't seem to say what you think they ought to say. And I'll get into some of that stuff in a bit more detail. But I've seen a number of people make some pretty big mistakes applying 1033. And while normally you would think that the IRS ought to be, fairly liberal in applying 1033, they have not historically been liberal for it. And there's all kinds of cases where people have been civil and criminal fraud cases against taxpayers. There's lots of litigation, lots of cases. So just read it and be careful. So initial question is, unfortunately, your house was destroyed by the fire. Are you eligible as an involuntary conversion under 1033? The answer is yes. 1033 provides that if property, as a result of its destruction in whole and part, theft, seizure, requisition, or condemnation, or threat or imminence thereof, is compulsorily or involuntarily converted and either into similar property, which won't apply in a fire, or into money, then you are eligible for the relief provided in section 1033. The most common area where most people run into 1033 is the condemnation area. However, even that is not the most common. The most common is threat of condemnation. But here, fire is clearly a situation where you have a involuntary conversion of your property and it's conversion into money. Now, under 1033, if it's converted into other property, which is very rare, it's mandatory. If it's converted into money, whether or not you can defer your gain is elective. When I tell people it's elective, the first or the professionals, they say, I can't find the form. And the answer is there is no form. You make the election weirdly by excluding the gain from your tax return. I've always been really, really uncomfortable with somebody who has like, $500,000 of income, they have a condemnation or a fire and they're excluding, say, $3 million, insurance check from their income by just not reporting the $3 million. And what I always consider best practices is to affirmatively make the election by attaching a white paper disclosure to the return that sets forth what happened, what was received, what was your basis in there. And that serves several purposes. One, in case there's any doubt that you were making the election, it's there. Second, it serves as a reminder that you need to replace the property. And third, there is a special longer statute of limitations for audit if there's a substantial omission of income on your return. I believe it's a 6-year statute. And if you, oftentimes is the case with people with involuntary conversions, the amount excluded is greater than that limit. And so you can avoid, in the event, not that anybody would ever do this, taking an aggressive position on an involuntary conversion, you can avoid the 6-year statute by filing by the disclosure statement. And it's just, like I say, plain paper disclosure that you just stick somewhere back in the footnote or pages of the return. And I always consider that a good practice.
Hey, Adam, I'm sorry to interrupt you. Isn't it kind of good though, if somebody is, not somebody you're not advising, because I agree with you completely, but isn't it it can be nice to discover that someone sort of is deemed to have elected 1033 by not putting something on a return? In other words, something from a year or two ago. Have you ever seen that done?
I've seen it I've seen it both ways where, well, a number of different ways. I've done this for a long time. One is you have people who had involuntary conversion and forgot about it. And now the time period's passed. Or they had involuntary conversions, they replaced the property and forgot that they replaced it. And I've also, so it serves a number of different purposes, but also like, what year was it? Because I'll get to in a minute, how long you have to replace is also confusing under the statute. So does that answer your question, Rob?
Yeah, no, it does. Yeah, yeah, it does. Absolutely. Thanks.
Yeah, so I think that's just, it's a good practice, but it's strange, and we'll get to another area also where just strangely 1033 just has a completely different process than what you'd expect. But most other code sections actually have a form. It's kind of nice that you can just exclude it. The second area I wanted to cover is an area which people often get wrong, which is how long do you have to replace? And most people say 2 years. Well, the one thing that's sure is that it's not 2 years. For almost all involuntary conversions, and then somebody says, well, all right, it's not 2 years, it could be 4 years, or it could be 3 years. Also wrong. The correct answer for most involuntary conversions, it's the end of the second taxable year after the taxable year in which you realize gain. So let's say you had $1 million basis in your property. There was a fire, destroyed it in January of this year. You receive $800,000 of insurance proceeds this year. When does your 1033 period expire? It doesn't, because you've got no amount realized. It's less than your basis. The clock hasn't started yet. Let's say you received $1.1 million or $1,001 in July. Now you do have an amount realized. Amount realized isn't gross proceeds. It's, in the case of a sale or exchange, it's amount received above your basis. So if you receive money in 2025 in excess of your basis, then the earliest the statute could run, assuming a calendar year taxpayer, is December 31st, 2027. Even though I work for an accounting firm, I'm always check my math. Now, the second period that you hear people say, but there's a federal disaster area, I get 4 years. Well, first off, you wouldn't get 4 years. You would end up the end of the fourth taxable year after the taxable year in which you realize a gain. But a common mistake people make is not actually reading that section, because yes, there is a 4-year period, but only for the involuntary conversion of a principal residence. So if it's not your principal, so if it's your business, it's 2. If it's your personal residence, it's 4. So for people who had their personal residences destroyed, and if they receive proceeds this year, 25, then you have 4 years, 26, 27, 28, 29. December 31st, 29 is when the period runs out. Now I've gotten people questioning, say, well, the period's not going to be long enough for me to replace or rebuild or buy something. 4.5+ years is a pretty long time for personal residences. So, but that is how the period works. There's also there's also, I see you got a question up there. It can be longer. So I'll get to the question from Susan. There's also a 3-year period, but that only applies to real property taken by condemnation or threat of condemnation. So that wouldn't be in this case, but it does happen. So what happens if you can't, let's say you want to rebuild, but you can't rebuild within the 4.5-year period? There is a process for the IRS does have the ability to extend the period, and they usually extend it either 6 months or 12 months at a time, although you have to apply for it. And the way you apply for it is you have to go in for, most of us who are young like me would call it a private letter ruling, but technically it's a determination letter. And the difference between a private letter ruling is filed with the IRS national office, and you have to pay a fee and wait forever. A determination letter is filed with the local IRS office, what used to be called the district director. There is no fee, there is no form, there are information that you're supposed to put in there. And I know one person said, well, won't it sit forever, with the LA district? Actually not. Each IRS district has somebody who specializes in 1033 determination letters. And I found historically they've been very responsive. And also if you put in there that, hey, been working diligently, it takes a long time to get approvals or building, I'm doing this, and I haven't completed it yet, they are pretty generous in granting either a 6-month or a 1 year. And I've actually, in some situations, had multiple years of determination letters extending it, but you have to be showing that you're working diligently, or that there's a real reason for doing it. You can't just sit there and hold on to the money for 4 years and then, on November of 29 go, oh, I need to buy something, and then ask for an extension because you haven't done anything. That won't work. But that's how that works. It's like everything else in 1033, it's a little tricky, but that is how that works. So the other part about, all right, so moving on from the date. Go on to the next. So moving on from there, 1033 applies to the insurance proceeds you receive for the fire. It also will apply to if you sold the land. It will apply to the land, and you can add that as your proceeds. Now, if we're talking about a personal residence, gain from unscheduled personal property, which is pretty much all your personal property, is excluded. Nice benefit, but typically you won't have much in the way of gain for that, but you don't have, what's nice is that you don't have to go in, insurance company cuts you a check for $100,000 for all the personal property. You don't have to go in and prove basis for $100,000. The second thing is the second thing is that all the money you receive for the destruction of a personal residence is considered one pot. It's considered a single property. So when you build your new house, you don't have to allocate between different pots: land, landscaping, building, whatever else. It's all just one pot for purposes of that. So that's good. Now, other things I want to talk about is the general standard for 1033 is the property replacement property has to be similar, related in service or use. That is a different standard than the 1031 like kind standard. You always get the question, is it broader? Is it narrower? The answer is yes. It is both broader and narrower. One of the most famous rulings that I consider wrong was a bowling alley and a pool hall will not considered similar, related in service or use. Your position as an owner of property is not similar, related, service or use to your position as a lessor or as a lessee of property. So you have to be if your home was destroyed and you're buying a new home, that's fine. That's going to work. If your home was destroyed and you're going to enter into a long-term lease of a home, that may not qualify. So you do have to be careful in what you do. And if we move on to business property, it's considerably narrower. Inventory has to be replaced with inventory, machinery with machinery, real property with real property, and it has to be essentially, there's a functional use test in the same area. I saw one more question come up, which was the extension refers to a district director. There is no more district directors. Well, maybe the IRS will get reorganized again. They'll come back. You have to file it with the equivalent of the district director, which is basically what I said before. So basically the local office. But it's a little hard to find, but there is a special place where you can file it. So I think, I'm trying to think anything else is important in there. All kinds of special rules in there. With business property, you can buy control of stock of a corporation. There's
Hi, Adam.
yeah.
I was kind of wondering how these rules compare to like-kind rules.
Well, I think Matt's going to get into that in a minute, but the biggest issue is with like-kind exchange rules, you have to worry about debt and you have to worry about receiving cash. Under 1033, you could receive the cash, pay off your debt, use the money for whatever purposes you want. And then when you reinvest, go out, borrow 100% of the purchase price, and that's just fine. So I know some people are saying, oh, some people are getting, a pot of money from their insurance company, and they would just keep that, and you just keep that, and you can reinvest any way you want. 1033 is much more restrictive, both on the time periods and is much more restrictive on the time periods and also on the ability to hold on to the cash. With that, I think I'll turn it over to Matt to talk about more of the interaction between 1031 and 1033.
Appreciate it, Adam. Ian has a question that came in where he's saying in terms of SRSU, if you're replacing primary residence with a home you intend to rent, does that create a problem on a 1033? And that, Adam, I believe you would agree, would create a problem. This does segue nicely into the 1031, 1033 comparison, if only because what Adam's gone over is that 1033 in many respects is more flexible in 1031 because 1033 is outside the taxpayer's control and 1031 is based on a voluntary event. But at the same time, I think for going into 1033 for rookies, right? Adam, I think, went over probably the most important tax-related, comparison rather than a mechanical comparison. In my estimation, the mechanical difference that's most important between 1031 and 1033, that's very elementary. For those of you who have never done it before, 1031s require the use of a qualified intermediary unless the swap is simultaneous, which is rare. It happens, but it's rare. In 1033, there is no qualified use requirement. You may commingle funds, you may draw funds from different sources, and as Adam mentioned, which is extremely important, the debt equity replacement requirements that are present in 1031 don't exist in 1033. You may take all equity and replace it with all debt, and the flexibility, as I mentioned, is a public policy decision by Congress in enacting both statutes to allow greater latitude to victims of events that occurred outside of their control. But furthermore, I think if you go into the 1031, 1033 differences, one of the other things that you have to be mindful of, as my colleague Michelle was going over in her segment, the question is, if you're either in the middle of a 1031 or a 1033 and the disaster occurs, what is the relief that's generally available to you? And the relief is different depending on the type of exchange that you're in. Furthermore, as far as a 1031 is concerned, I think some of you folks that are part of the LACBA probably serve as local counsel for taxpayers who are doing 1031s and are not affected taxpayers, but the relief that occurs under the disaster notice as referenced by the revenue procedure still applies. And there is the differential between how that relief is going to apply. If you're a taxpayer, for instance, that's completely from out of state, but you may meet the requirements that are set forth in a revenue procedure to have that disaster relief notice applied to your exchange anyway. On top of that, right, in order for either 1033 or the casualty loss rules in 165, which I'm going to get to in a moment, in order for those to apply to you, here's the thing about the interplay between the actual statutes and the revenue procedure plus the disaster relief notice. You can't just do a 1033 merely because your property is located in LA County. You have to be located in LA County, but the casualty must have occurred to your property. And that, I think, it's a super fundamental, very basic distinction. But I think it deserves to be said, if only because we may have a range of experience levels on the webinar. It's the idea that, as Adam mentioned, you may have partial affect by the fire, whereby, I mean, take Adam's particular situation. As he was mentioning, you may have an insurance payout based on legitimate fire damage, but then also get proceeds from sale. What Adam went over is that you can actually roll those. You can consider those as part of a unified 1033 of sorts. But the thing is, what you can't do is that if you don't have the proper evidence to show that the casualty actually affected your property, 1033 is not available to you, despite the property being located in LA County. And when you take a look at the availability of 1033 and 1031, another fundamental thing for you to keep in mind, 1031, after the Tax Cuts and Jobs Act of 2017, is only applicable to real property. 1033, though, is widely applicable. And it's widely applicable not only because it also includes personal property. 1033 is more widely applicable because it doesn't require qualified use. 1031 does require qualified use. It's defined as use as an investment or productive use in a trade or business. The reason why they say productive is because, as Adam mentioned, inventory is not considered productive use in a trade or business. It is stock and trade. And therefore, it is not eligible for 1031 if property is considered inventory. What type of property is considered inventory? For instance, it's any property that was constructed with the intent of being sold to customers in the ordinary course of a trade or business. Real life example, you go ahead and purchase a large vacant lot. Then you go ahead and divide that into residential subdivisions, construct single family homes, and sell those homes one by one without ever having rented them to folks who want to purchase single family homes. That's inventory. Condominium buildings, new construction, the condominiums are never rented. They are sold as part of the offering plan out to individual occupants of that apartment. Those are also inventory, the condominium units. Those are eligible for 1033. And as Adam mentioned, it's super narrow when it's inventory. You must go inventory to inventory and make sure you closely match relinquished and replacement or involuntarily converted and replacement. On the other hand, the 1031 like-kind standard is much more broad. When you have the like-kind standard apply, it is a wide spectrum of real property that you may go into and out of. 1033 also cross-references 1031 insofar as the 2 years after the taxable year ends requirement that Adam was describing will be extended to 3 in the event that the property that was casualty under the fires did meet the qualified use requirement under 1031. And so if you're given the choice, right, 1033 is generally superior to 1031, legally and mechanically, because that's a policy choice that Congress made. Therefore, you would choose 1033 in the event that you're eligible for both. But if you don't have the actual fire damage, you will only be eligible for 1031 if the property meets qualified use. And you need to keep those differences in mind because at the end of the day, depending on your individual circumstances and the circumstances of the property itself, you may be eligible for one or both, depending on the characteristics. And I hope that this rundown gave you enough of an image to be able to start wading through the issues. Naturally, you want to get qualified help from an attorney or an accountant in the event that you want to parse through this more closely. But what I hope we gave you here was the fundamental foundation to be able to evaluate that. Now,
Matt,
yeah,
one
go
thing I
ahead.
want to interrupt, there's one other section that we should mention, which is section 121, the rollover of gain on a principal residence. That is still available in the event of a involuntary conversion, but if you remember, it's limited to 500,000 for married and 250,000 for an individual. And so for a lot of people in California, 1033 will be much more generous.
Well put.
I'm sorry, go ahead.
Yeah, no problem. One last thing, we're going to go to casualty losses. Now, the thing is, right, if you end up with a property that may be affected by the fire and you're thinking, you know what, for various reasons, I don't know if I want to replace that property. What else might be available to me? Now, to the extent that any financial loss that can be sufficiently proven is not covered by insurance or another similar payout, like any sort of government relief payout related to the property, things like that. Section 165 does allow for a casualty loss deduction. And unlike a lot of other provisions in the code, it does allow for the deduction of financial losses up to a limit. The limit is the basis in the property that suffered the loss. So you can't get like a windfall. But the thing is, if you can sufficiently prove that there was a mere financial loss in the fair market value of the property in question, you can go ahead and instead of going and converting by reinvesting the proceeds that you may receive, if you don't even receive proceeds, because the property may have been uninsured. Like, for me, our offices, we have offices in Orange County, California, but I myself am a New York domiciliary. So I don't have personal experience with the FAIR plan, for instance, and the crisis that's occurring with the California property insurance market, but I've read about it and I generally understand what's going on with it on a surface level. And my understanding of it is that there is question right now as to whether or not the FAIR plan can cover the LA County fire losses adequately, whether or not private insurance is going to pay out completely or whether it's going to pay out partially or all that business. So in the event that insurance doesn't adequately cover the losses, you do get a Section 165 casualty deduction. In addition, it's available for personal property and it's available for vehicles. So in the event that you are either uninsured or inadequately insured to that extent, there is the possibility that if you can show that loss in fair market value not covered by insurance, you can just claim an ordinary loss. Now, there was a rule under the Tax Cuts and Jobs Act that basically went ahead and wiped away casualty losses on personal returns, but it's suspended for federally declared disasters. So LA County fire victims don't have to worry about that. What also got suspended for those disaster victims based on a 2023 bit of legislation mentioned in the materials is the 10% adjusted gross income limit that you must exceed. The loss has to exceed that to be deducted. Weirdly enough, that relief from the 10% AGI limit for federally declared disasters expired theoretically about 2 or 3 weeks before the fires occurred. Now, my crystal ball is always broken on this. I've been through 4 major legislative cycles on tax, and I predicted wrong in like all of them. But I would bet that the federal government allows for that 10% AGI holiday to occur for the LA County fire victims. It's just that that legislation is not there yet. Therefore, theoretically, under the 2023 legislation, you would still need to have the 10% AGI limit get exceeded, but I would bet the feds do something about that. That's also the rule for California, by the way. And most of you probably know that California doesn't necessarily conform to the federal Internal Revenue Code. It's got its own rules. The casualty rules do mirror the Internal Revenue Code, except the 10% AGI limit is definitely there. And you're going to need to do that for California purposes. I'm not going to put Topher on the spot, probably because he's not even qualified to comment. But regardless, I would imagine there's some possibility that there's legislative action in California. To my recollection, as far as I'm aware, there was legislative action for the Woolsey, the campfires and stuff like that on certain aspects of disaster relief. So the California legislature, I would have to imagine, will act on this. And, that 10% AGI limit may well get suspended also. But you have to wait to see what Congress and the California legislature respectively may do about that. And that's the rundown on casualty losses. I don't know, Levon, based on the time we have left, whether we can go into questions, but I do want to cede the floor and make sure we've got time to cover the other material.
I have a
Thank you.
question, Matt.
Thank you for asking. Just real quickly for both of you, we're going into settlements at 5 o'clock, so we've got 6 minutes. Go ahead and address
No, not bad.
to the extent you can. Either you could type your answer or on screen.
So Matt, I was wondering if you could address, I know there's different provisions as to whether or not you would have to take your casualty loss on your 2025 return or whether or not you could go back to 2024.
Yeah, I mean, it's interesting because, the federal government got rid of basically all carrybacks in the Tax Cuts and Jobs Act. It was one of the revenue raisers they had, where originally, for instance, on a business level, you could take a net operating loss and carry it back, right? But, and I just want to go ahead and pull up my materials because the carrybacks are mentioned. This is on slide number 24. It's the second to last slide in our materials from my firm. And in fact, right, it has to, it also has to do generally with this whole Federal Disaster Relief Act business. But there is the notion, right, that if you go ahead, wait, am I on the wrong slide? I might be on the wrong slide. Nevertheless, though, there's a provisional carryback that is available in the event that you suffer, for instance, the casualty loss in 2025 based on the wildfires, and then you go ahead and, submit, basically, to my understanding, an amended return to go in and carry back the loss that you may have occurred based on casualty. And as the slides mention, it may help you get cash faster. Because if you can substantiate the loss per the rules, and then you go ahead and make the application for the carryback, it's just like the principle was when Congress allowed NOL carrybacks prior to the Tax Cuts and Jobs Act. What the principle behind it is that when you have taxpayers who are affected by these adverse circumstances, it allows for the opportunity, not just because tax benefits sometimes, as we all know, can be paper benefits. They're paper benefits that are eventually valuable. But the thing that might be most valuable to folks that want to claim the casualty loss and look into going that route for tax relief, it's cold hard cash. Like, it's the idea that you could go ahead, apply the carryback provision that's available to you under the casualty loss rules, and then turn around and get cash in your hand as a matter of relief, rather than what might amount to a paper benefit, or the idea of deferring taxes by way of replacing your property under a 1031 or a 1033 provision. So it's good, Adam, that you went ahead and brought that up, because in the event that you want to apply that, the carryback may go ahead and allow you to get cash related relief on a quicker basis than you otherwise would.
Thank you.
Yep.
We have a number of questions in the chat. I was wondering if you or Adam would want to answer, have time to answer one or two, and then I'd like to invite, for people who don't get questions answered, maybe we could take a few minutes when the program's all done to follow up on some of these if needed. I'm happy to. So for instance, we have one: must you use all the money or invest all the money within the statutory period? So if you're in the middle of the reconstruction, do you need to seek an extension? I think Adam spoke.
I think, Adam, you referenced that if you're in the middle of it. Yeah.
Yeah, if you're in the middle of it, the question is, have you already expended a sufficient amount to roll over all your gain? And if you have, then you can do it in the middle. But generally, it's going to be the case that if you haven't expended all of the money, that you're going to need to request an extension. And that would be a good reason to get an extension, so long as you didn't start construction like a month before your period ended.
Thank you. So the similar use, I think that you discussed the similar use and the definitions under both statutes.
I think Adam sufficiently addressed that part. LaVon, I'll turn to Brad's question for a moment. He's talking about whether or not there's a loss on personal property, right? Inventoried property basis will exceed insurance recovery.
Yes.
You have to net that loss against the gain resulting from the sale of the land and insurance recovery together exceeding total basis. I don't know whether, Brad, you had meant a loss on real property for personal use, or personal property that is not real property. But either way, I think, Adam, there is no rule necessarily saying that a loss needs to be applied in a certain way on a tax return if you had so chosen. Like, for instance, if you have an ordinary loss and a capital gain, I can be corrected by Adam, Rob, or Terry on this, possibly, basically anybody. But to my understanding, that even though you are eligible to use an ordinary loss against capital gain, there's no requirement that you do that. That if you wanted to say, well, I may have an ordinary loss in a later year and I'll get a better overall benefit if I use, notwithstanding the time value of money, if I use my ordinary loss in a later year because I don't have one this year, there's no requirement that you must net that out. There are netting requirements, for instance, like Section 1231, where you have Section 1231 property and stuff like that. But those netting rules are a little niche for losses that you take in a casualty like this, or gains that you may defer and things like that. I'm not aware of any rule that mandates you to net.
Yeah, I don't think so. And also, but I think the loss on the personal property would have to be deducted under as a casualty loss, because personal property is different. I did want to go back to Ian's question about similar use. If you're replacing your primary residence with a home you intend to rent, if you intend to rent it, it's not your primary residence. It's the same rule as 1031. So therefore, the answer is if you intend to rent it, then it doesn't qualify. You have to intend to live in it, and then at some point later, change your mind and decide to rent it. And there's a whole bunch of 1031 cases on that. The general rule most people think is 2 years for people to change their mind. But phrased the way you put it there, the answer is it doesn't work at all.
Thank you, Adam. Thank you, Matt. I'm gonna.
LaVon, 1 second here. Vivian has a question. I just found the material in the slides, and I want to make sure that Vivian's question is answered. She's
Excellent.
asking if we have a reference for the NOL carryback. NOL carrybacks were disallowed as part of the Tax Cuts and Jobs Act of 2017. However, the companion concept I was talking about under casualty, that is section 165I, I like India. That is section 165I of the Internal Revenue Code. That is your option to go ahead and apply those losses in a prior year, which effectively carries them back. And that's your statutory citation. I believe that's what Vivian was asking for. And I was fumbling around with it a little bit early on, but I found it in the slides. I'm going to give you the slide number in a moment. That is slide number 21 in our firm's materials. You can go ahead and see it there. And LaVon, I think I will cede the floor for good this time.
No, not for good, just for the moment. And we'll turn now to Rob Wood, talk about trigger of settlements and payments.
Thank you, LaVon. I'm Rob Wood. I'm going to give you a necessarily kind of motor mouth abbreviated version, something that I think most of you hopefully, I mean, it would be nice if you could start thinking about litigation recovery soon, but for most people, I think it's likely a ways off. Mostly, I just like to reference a few things in my materials, which the slides I'm not putting up on the screen. But I just kind of reference points, and many of these things I think tie into some of the comments that other panelists have made. First, slide 3, not every payment you get is something you don't have to worry about. It's there are tax consequences to virtually any kind of payment in this context. Don't be misled also by failing to get a 1099. Many kinds of payments do not trigger a 1099. I find that it's a common misconception that people have that a sort of a payment isn't something you need to worry about unless you get a 1099. Both Edison, Southern California Edison, and PG&E and the Fire Victims Trust, they all decided on all of the other fires in the past not to issue 1099s to people, which was technically the right decision. But again, just because you don't get a 1099 doesn't mean it didn't happen. Slides 4 through 10, some of this was covered by others, but is about insurance proceeds, different kinds of insurance coverage. Despite what I just said about payments not having tax consequences, some types of insurance payments, like coverage for personal property in a federally declared disaster, aren't taxable. That is, are tax-free. There's some exceptions. So I guess just whatever the property tax insurance or any other kind of insurance that you may be getting, hopefully soon, just pay attention, and you may want to look through these slides. Slide number 11 is about the recently passed, back in basically around Christmas, a federal tax bill that exempted a lot of wildfire recoveries, a bunch of important things there. But I guess most notably, it doesn't cover anybody beyond 2025. So it's what's going to happen if you get a litigation settlement next year, the year after that, the year after that. It's not clear yet what's going to happen. Casualty loss deductions, Matthew mentioned, others have mentioned. Slides 12, 12 through 15, I think. I think there's a lot of concern now. Should people such as Palisades, fire victims, claim a casualty loss deduction, especially if you have very limited insurance? It's worth thinking about. Historically, my personal experience, at least with litigation recoveries, is that some people who claim casualty loss deductions end up regretting it because it can later be recaptured as ordinary income in a subsequent litigation recovery. And finally, hitting litigation recoveries, slides 17, 18, and 19, I think, and 20. Some rules there. I guess the biggest one to flag, which is not intuitive, I don't find, and this is true across just about any kind of litigation recovery, not just fire recoveries, is that people tend not to think about the legal fees if they're using a contingent fee lawyer. $1 million settlement, the lawyer collects the million, sends the client $600,000, assuming a 40% contingency. I think most plaintiffs that I see today and historically sort of automatically assume the biggest tax hit there could be would be $600,000 in that example. But there's a Supreme Court tax case that says, no, it's $1 million. Doesn't mean paying tax on the legal fees. There's almost always a solution, but just to flag that for you. And then finally, at the end, slide number 21, these are all articles that you can get that will do a much better job than certainly I have done here of sort of flagging tax issues for you. And these are all in different publications, some of which you may not be able to get, like tax notes in the LA Daily Journal, unless you subscribe to those. But if you go to woodllp.com and sort of type in these things, you can pull them up and download them for free, and they might help you. And that, I think, is the end of my motor mouth spiel. Thank you, everybody.
Well, thank you very much. We have a little bit of time here, and I see there's still some questions up here. I don't know if anyone wants to answer them, but any questions that don't get answered now, we'll try to get them on the back end. So Adam or Matt, if you see something you want to grab, please do. Otherwise, I'll just throw something up. Anybody? So the insurance proceeds will mostly exceed the cost basis of the property should the excess be reduced by rebuilding costs.
It sounds to me, Levon, like a bit of a simplistic analysis about how 1033 and 1031 both work. There are commonalities between them at a fundamental level, one of which is that you do your math from the ground up, not from the top down. So let me sort of illustrate how this works. When in Esther's question, right? The phrasing of Esther's question is, well, the insurance proceeds will exceed the cost basis. Shouldn't we reduce the excess by the cost of rebuilding? It works in reverse. You count any dollars reinvested on either a 1033 or a 1031 by replacing cost basis first, and you're working your way up until you replace the entirety of the proceeds you received upon involuntary conversion or upon sale or other disposition. You don't count it by saying for every dollar I reinvest, I decrease the amount of gain I recognize. That is topsy-turvy. That's the reverse of how the statutes work. What does work like that is the opportunity zone statutes, which we don't go over in this webinar and are a completely separate topic. But the OZ program does work like that. The 1031 and 1033 programs do not. Those statutes say that as you make reinvestment, your reinvestment only counts to defer gain once you've exceeded your basis. So you've got to make sure that even though 1033 doesn't have the same rules on replacing debt and equity, if you receive a total insurance check of 3 million, to get complete tax deferral on that insurance check, your reinvestment into the replacement property must be at least 3 million.
Thank you, Matt. Very helpful, much appreciated. We are going to turn over to now Caesar, but before I do, I saw this note that was to Rob and wanted to share it. You know, now it seems that it was gone, but I think someone was thanking Rob Wood for his articles after the Woolsey fire. And just wanted to make sure that, Rob, that you saw that. And we have some questions about the FTV that maybe Topher can address on the back end. But right now I'm going to turn to Cesar Reynoso, talk about Los Angeles County Assessor's Office. I want to ask a quick question as you get started, and that has to do to whom would relief apply for these purposes, Cesar? Because I don't think we've referenced LA County with respect to certain IRS and FTD relief, but you know, what's the basis of the relief out of the assessor's office, and isn't it more narrow in terms of to whom it would apply?
Well, it's going to go ahead and apply to the actual homeowner, and the laws are pursuant to, you know, the Board of Equalization, State Board of Equalization, that goes ahead and provides a lot of guidance, but ultimately we always go ahead and refer back to the Revenue and Taxation Code. So I think a lot of the California property tax goes ahead and, at least in some degree, takes some direction from federal income tax law.
Mm-hmm.
So a lot of my clients, you know, have gone ahead and contacted me telling me, you know, Caesar, I just went ahead and I purchased my property in Pacific Palisades for X amount of dollars, let's say $10 million. I just moved in last week, and a week later, you know, fire went ahead and burnt down the property. So my property was assessed at, say, $10 million. So just the ad valorem tax rate alone is going to be equal a tax liability of $100,000 annually. And once you factor in voted indebtedness and direct assessments, you know, the all-in tax rate could be, you know, 1.2% or $120,000 a year in this particular case for property that no longer exists. So pursuant to Revenue and Taxation Code 170, there is relief for homeowners that they can go ahead and seek. Essentially, Revenue and Taxation Code 170 calamity claim is the process by which a homeowner goes ahead and requests that the assessor reassess the property as of the date of the calamity. So there are a few requirements. First, there needs to go ahead and be physical damage of at least $10,000, which is a foregone conclusion that even something as minimal as smoke damage, unless your home is airtight, there's going to be smoke that's permeated into the house and into the HVAC system. And I think it's going to be very simple to go ahead and satisfy that requirement. There also needs to be a natural disaster declaration, which we have in this case from Governor Newsom. And the damage to the property actually starts, you know, the day of the fire, you know, when property access is restricted. So as soon as you no longer have access to your property because you were forced to evacuate, that's when the damage starts to occur. The file application for this request for reassessment needs to go ahead and be submitted to the assessor's office within 12 months of the date of the calamity. So January 7th for the Palisades fire, January 8th for the Eaton fire in Altadena. And the form that needs to be filled out is ADS Form 820, which is relatively straightforward and can go ahead and be downloaded from the LA County Assessor's Office. Now, in conjunction with a Prop 170 claim, Prop 194 is the actual process to go ahead and request a deferral for the next installment of property taxes, whether that next installment is the second installment of 2024 taxes in this case, which would be due April the 10th of 25, or if you purchased your property and your next installment is your supplemental tax bill. Governor Newsom went ahead and extended the deferral through April 10th of 26. So essentially extended the deferral for an additional tax year. Now, the assessor is stating that, if you file a calamity claim, you don't need to file a tax deferral claim. But that's not what the law requests or asks. So Form ADS 820.3 is literally a 2-question form that we are going ahead and recommending to our clients that they simply go ahead and fill out so they're consistent with the law, because the deferral needs to be filled out in conjunction with a 170 claim. So how does the assessor go ahead and determine, what is the damage to the property? What's the process? Well, the assessor is going to look at the fair market value of the property immediately before and immediately after the fire. So the basic question is, what could my property have sold for the day before the fire, and after the fire, what is my property worth? Section 170 clearly states that the assessor must consider the damage to the improvements and to the land separately. So there have to be separate analyses that they go ahead and look at both the individual components of the property, both the land and the improvements. And the loss in fair market value of the property, it ends up being the percentage by which your assessed value is reduced. So let's say, for example, that your home, just the improvements, were worth about $2 million before the fire. After the fire, there's approximately 50% damage to the improvements. So that 59, now they're worth $1 million. That 50% is the amount by which the improvement value of your existing assessed value is going to go ahead and be reduced by. In most cases, we have 100% loss and damage. It's very easy, to calculate, because there unfortunately isn't anything there anymore. The bigger issue is not so much how the assessor is going to go ahead and look at the value of the property, because there are methods. You're going to have bids from contractors, from insurance companies. The assessor can go ahead and rely on information platforms through core logic, such as Marshall and Swift, where these information platforms go ahead and provide the cost on a per square foot basis as to how much it's going to cost to go ahead and put what was back on the property to reconstruct what was there prior to the fire. The assessor is going to, in my opinion, run into issues, and I think this is where there's going to be litigation, and that's as to the value of the land. So we can value what the loss is to the improvements, but if the property went ahead and burnt down, under normal circumstances, this would simply be a land valuation case. You'd go ahead and pull comparables to see what similar land or similar parcels are selling for, or you would look at homes that were being marketed as, tear downs to go ahead and determine what the land value of the property is. But here, you don't have a marketplace. It doesn't exist. What you have is a glut of thousands of parcels that now exist, and we don't know what the assessor is going to go ahead and do. They may try to go ahead and back into a value by saying, well, toxic materials permeated into the soil, into the first few inches of the topsoil, and it's going to cost X amount of dollars to go ahead and cleanse, the land that has been affected. And, and we're going to go ahead and deduct X, for example, in the Eaton fire location, where utilities in some portions of the area don't exist anymore. There's no water, there's no electricity, there's no gas. And I've heard that there are estimates of up to 18 months to go ahead and restore these utilities. So what is the loss of value? And the question is, we don't know, what it's going to be to the land. I can tell you that in Northern California, the Paradise Fire, initially the assessor, when they were going ahead and giving their determinations as to what they were going to do with regard to value, they only took value off of the improvements. They did not go ahead and initially take value off of the land. Eventually, after some pushback, the assessor did. At the end of the day, you must remember that the assessor's office is a revenuer, and they're always going to go ahead and take their chunk of flesh. And unfortunately, this is going to be a huge loss, and their coffers are going to be brimming with happiness in the next several years, unfortunately. And I think that they are going to go ahead and try and balance the public perception that what the assessor is doing is fair or not. And I think in many cases, it's going to be up to the homeowner to go ahead and question the assessor. So you go ahead and you file your claim. You don't know how long it's going to take for the assessor to respond, 6, 9, 12 months. Once they finally go ahead and do, you have 6 months from that date of the written determination to go ahead and file an assessment appeals application with the Assessment Appeals Board that is handled under the auspices of the LA County Board of Supervisors. And that Assessment Appeals Board hearing acts, as, or essentially is the equivalent of a Superior Court hearing. The laws of evidence are a lot more relaxed, and there is a 3-panel board that will go ahead and make a decision. And I think that is where a lot of people are going to go ahead and push back if the assessor doesn't go ahead and reduce the land value as well. We'll just have to wait and see. I'm beginning to see that some people in the Palisades, for example, are starting to go ahead and sell their homes. In particular, one home, that I would have valued just the land at about $4 million, before the fire, sold for under $1 million. So that is a 75% loss in value. So hopefully the assessor will do the right thing, and mitigate the grief that people are already experiencing. So let's say now that everybody's in agreement that what the assessor's determination is reasonable. So then what happens next? Well, you will go ahead and start the rebuilding of the property. There is no bright line rule as to how long you have to go ahead and build the property or to construct it again, as long as the time frame is reasonable. Well, reasonable under these circumstances is going to be something different, because you have thousands of people that are looking for an honest and trustworthy contractor. They're going to have to get in line, because they're going to be, a litany of people likely that are ahead of some people. And, I'm assuming that sourcing materials and the costs associated with those materials is going to be significant. And so that'll be another challenge. But let's say, for example, that 20% of the property has been rebuilt as of January 1st. Every January 1st is a new subsequent lien date, and the assessor will go ahead and look to go ahead and put back value as of each January 1st. So if 20% of the improvements are rebuilt on a property that was completely destroyed, 20% of the prior reassessed value will go ahead and be placed back onto the tax roll.
This is
Yes.
very important. I'm gonna interrupt you.
Sure.
I probably have to turn in about a minute. Should I come back to you, or what should I do?
Let me go ahead and just go really quickly. Like for like property, once you go ahead and you rebuild the property, you're not going to go ahead and be reassessed. If you build a brand new beautiful home that is 2,000 square feet and that's what you had before, you'll keep your same base year value. If you build a 3,000 square foot property, everything above the 2,000 square feet will go ahead and be added on to the tax roll as reassessable new construction. Finally, let's say you go ahead and you build the property. What is my final value? Well, it could be that if you bought your property in the Palisades just a few years ago, your value may end up being, your assessed value may end up being higher than what the fair market value is once you complete construction, because maybe values having come back in the neighborhood. So the assessor will go ahead and take the lesser of the fair market value of the property as of the completion of new construction date, or the trended base year value as of that same completion of new construction date. If you have time to come back to me, we'll go ahead and discuss what people that have very low base year values that purchased 40 years ago, what they can go ahead and do. Because even if the assessor goes ahead and reduces value by X amount of dollars, it may not be economic for those individuals to go ahead and file appeals, simply because on a percentage basis, they're not going to see much of a discount, because they already have a very low base year. But if these people want to go ahead and move away, there is relief by them being able to take their existing base year value on the damaged property to a new property somewhere else.
Okay, we'll hold that because that's an important point, and we will circle back.
Sure.
You would take a look in the Q&As. I think that there may be one or two that are for you there.
Sure.
Meanwhile, I would, I now want to turn to Megan to talk about what happens when these mortgages get deferred or ultimately canceled, can't be paid. What happens, Megan?
Perfect. And so thanks everyone for joining. And I just want to say, for anyone who did lose their house, or was otherwise negatively impacted, because it's not just losing your house. I know a lot of people who are in neighborhoods where their house is the only one standing, and that's not necessarily all that much better. And so for those who have suffered a loss, I'm very sorry for that. And so I'm just going to touch on a couple of quick points here, because I know we're coming to the end of the program. So first of all, you can have your mortgage or lease, or you can have a forbearance on that potentially. And so basically, under those kind of rules, your lender is going to let you temporarily pause or reduce your mortgage payments, typically due to financial hardship. And I know there have been a lot of stories about what happened and all these rich people losing their house in Malibu, but those of us on the call here in Los Angeles, we know that most of the people who lost their homes were not wealthy. A lot were retired. They had big mortgages on houses. They really now are facing some financial hardship. And so in this case, when you're trying to get mortgage forbearance, it's not automatic. Even in an emergency situation, you typically have to show the financial hardship. It doesn't, when you're getting this forbearance, you're not basically getting released from this requirement, whether it's for the lease or for the mortgage. Instead, basically, you're getting extra time to basically pay. And it's different from a deferment, because a forbearance is an actual pause or reduction in the payments, whereas deferment is basically an option for making up past due payments by moving them to the end of the period. The other thing I wanted to talk about very briefly is, okay, so let's say that you get a cancellation of debt instead. And so we probably all know the basic rules for cancellation of indebtedness income, but basically that's where a lender is forgiving the debt of a borrower. That could be because the borrower can't pay. It could be that only part of the debt is forgiven. There's a whole bunch of variations on that. I think we also oftentimes see that where family members will forgive debt of someone else, or business partners might forgive debt of someone else. There doesn't have to be any cash going back and forth. And then there can be certain restrictions if there are things like net operating losses to offset the income that results from this cancellation of indebtedness. And so here, if you do have that type of cancellation of indebtedness, that is taxable income to you. And a lot of people are surprised when we tell them that, but that's the unfortunate reality. I'm not going to go into much more here, but I just want to make one thing clear, and that has to do with the timing, because, right, to have that ability to either declare income, and also for the person who's taking the loss, potentially they want to declare that loss as well. It's not just the person getting the cancellation having income, it's also the other side of the equation, someone else might want to take a loss on that. You need to have some sort of realization event. Most typically, there are some regulations which address some of that, which you can take a look at, and that's in my materials. There's a reference to that. But that's something that you want to know in advance, that you have to have something that identifies so that you can file something correctly. I think that's all I'm going to talk about because I think we're now at the end of our program. But I do have more information on cancellation of indebtedness income in the slides. So thank you very much for participating.
Megan, thank you. And you provided excellent slides, and I know there's a lot of information that people can find there. So when I please definitely refer to the materials. And again, Megan, thank you, and for the materials as well that do answer a lot of questions in that regard. I am told that we need to start shutting down. I wanted to let Caesar finish his point on that question where he left us all on tenterhooks. And then with respect to all the other questions that have not been answered, I am advised that we can get those, those will be provided to me and I can share them with our illustrious panelists to follow up. So Caesar, I kind of interrupted you, and I think if you could go ahead and finish your point and then
so
turn it over to Terry to wrap up.
Thanks, Levon. So I'm quickly going to go ahead and address the last question. I was starting to go ahead and get into the base year transfer of your existing assessed value to a replacement property. So the calculation in this particular case is what was the fair market value of the property before that fire? What could it have sold for? That amount is is equivalent to the sales price under a normal scenario, normal analysis, when somebody who's 55 and over wants to transfer their existing base year to a new property. So in this particular case, the assessor will go ahead and determine what they believe the property would have sold for. Then you purchase your replacement property, and likely the fair market value of the property. You were represented by a real estate agent. It was in the MLS on the open market. And once you go ahead and you get that value, you go ahead and compare both values. If your property was worth $2 million and you purchased a property for $3 million, the difference between the two is $2 million. And then you would add in your existing base year value. So if your existing base year value was $500,000, your total all-in new tax rate on your replacement property would be based on a value of $1.5 million. The difference between what the property was worth and what you purchased the replacement property for, and then you add in your existing base year value. Okay. And if people have more questions, they can go ahead and contact me anytime. I'd be happy to field the questions and point them in the right direction.
Well, thank you. And I will, I'll get to a list of the questions. I'm not sure, maybe Terry, you can tell me the best way, like maybe there's some central point where people can find the answers like ours, because I don't want to put it on the speakers to have to chase people down to answer, but I would love, if we can, have a place where, we can let people know where answers can be found. I don't know. So I'll figure out something. Yeah.
We'll have to see what we can do on the additional questions. By the way, I want to thank everyone who spoke in particular. I think you'll certainly, anyone who attended recognizes there is an enormous amount of expertise represented by the different speakers in the program. I mean, it's, probably 150 years or more of expertise in taxation. An important thing to derive from that, and I think for many taxpayers, and I know we have many non-professionals who are listening to this, I think this is a good time. I mean, we've gone over issues, but we've had to go over them quickly. I think that if you suffered substantial damage from the fires, I think this is probably a good time to rely on specialized tax advisors. And it's not always such a good idea to do all of this on yourself as self-help tax planning. I know as I think through the nuances of 1033 and other things like this, you don't want to make a mistake. You want to do it right. So I very much encourage you to seek competent professional tax advice. And again, I certainly have tremendous sympathy for anyone in the audience that did suffer damage in this fire. All right, as a final note, and it is in the chat box, there is a link to many materials that are available through the association on the fire and different resources that are available. And with that, I want to again thank our speakers, thank everyone who attended. Thank you very much, and good evening on behalf of the taxation section of the Los Angeles County Bar Association. Thank you.